to our U.S. Oil Market Outlook webinar today. We're excited to have you with us. My name is Shannon Fokin, and I'm part of the energy marketing team here at DTN. Before I introduce our speakers, I'd just like to run through a few housekeeping items. You'll notice that everyone is muted upon entry, just to reduce background noise, but we do encourage you to ask questions, as there will be time at the end to do so. So please type your questions in the chat window, which can be found on the bottom right-hand side of your screen, and we'll get to as many as we can in our allotted time today. Additionally, we will be sending out an email in a day or two with a link to the rebroadcast. So without further ado, I'd like to introduce Troy Vincent, who is our Senior Energy Market Analyst, who has been part of DTN for close to 4 years, and also Kareem Bastadi, a Market Analyst, who has been with us for close to 2 years. So thank you for joining us, fellas. So with that, Troy, I'm going to pass it over to you.
Right. Thanks a lot, Shannon. So let's go ahead and just jump into the presentation. All right, so coming into the year, we had many bullish narratives converging. OPEC was cutting production, China was reopening, and Russian crude and product sanctions were either going into effect or soon to go into effect. And yet, while all of these things ultimately did happen, higher prices simply did not follow. So today we're going to take some time to recap why that was the case and why, as we've written in recent months, the second half of the year is shaping up quite differently from a price perspective. So while we won't be able to approach this webinar fully from a chronological perspective, given how many of these events and developments have overlapped over the first half of the year, we do think it's necessary to go ahead and start the conversation with the first major development for oil and gas markets moving into 2023, because it left a lasting impact through the rest of the year. And that is weather, and winter weather at that. So weather developments have played a central role in oil and natural gas markets this year, particularly impacting the industry in the US and Europe, but also therefore impacting global prices. In the US, extreme cold temperatures in late December through early January shut in around 3 million barrels per day of refining capacity, helping crude stocks build rapidly. Domestic fuel demand weakness was exacerbated during that period of extreme cold conditions, leading product stocks to build despite the weakness in domestic refinery runs. On the other side of the pond in Europe, however, winter weather was shaping up quite differently. Extreme warmth in Europe led to resilient natural gas inventories throughout the winter, despite a lack of Russian pipeline supply. And ultimately, an unprecedented mild winter across Europe led to a dramatic decline in natural gas demand and prices, and this in turn limited gas to oil switching demand and helped relieve pressure across the entire oil and gas complex. And this handed the G7 a major win in their efforts to limit both inflation domestically and Russian revenues.
Yeah, and speaking of Russian revenues, the Russian crude oil are continuing to flow onto the market in those quantities that we've seen was probably one of the biggest disappointments for oil bulls throughout the first half of the year. And they're, shouldn't have taken them entirely by surprise because, the G7 price cap, for instance, was designed to do exactly that, to limit Russian revenues while allowing for as much oil as possible to keep flowing freely. Since we're more concerned, especially last year, if you think back, about fighting inflation than necessarily Russian state revenues. Now, on top of the ineffectual price cap for euros, for instance, that was set far above where euros was trading for most of the time until very recently, when euros surpassed that cap. So that we had a fairly ineffectual price cap on euros, and for grades trading above that cap, it was largely irrelevant since they, like ESPO, for instance, they don't rely on European shippers. Russia was also able to circumvent sanctions by the use of their growing shadow fleet, comprised of aging tankers, and in fact, volumes not only kept flowing, but they actually increased. Right, we saw exports from Russia pick up substantially throughout the first 5 months of the year. Now, if you go to the next slide, please. Now, on top of that, we saw, the first 5 months repeatedly a lot of announcements about cutting exports, cutting production by Energy Minister Novak. And these announcements did send prices, higher for a short time at least. But none of these cuts were ever realized. In fact, exports rose by around 500,000 barrels per day between February and May. However, we did see a decline in both June and July. And this, coincided with the time when Indian refiners are stepping back purchases in general and seems to be stepping back purchases of Russian oil in particular. And of course, at the same time that, crude demand at home in Russia is hitting a seasonal peak when refiners are returning for maintenance and, they want to meet summer demand. All this, being said, we did get the sense lately that Russia is much more determined and serious about these cuts lately. And, so there really was Saudi Arabia and OPEC Plus. And they did, announce to cut August exports at least by 500,000 barrels per day from July levels. And part of those cuts through to September. Now, since the, effect on supplies wasn't really there, what was the effect of any of these sanctions and price caps? Well, we did see a giant rearrangement of trade flows. Not only, right, like often talked about, crude flows to India and China and other places, but we also saw it on the oil product side, where you had, for instance, Saudi Arabia, which isn't necessarily a particularly large importer of middle distillates, suddenly start to import huge amounts of Russian diesel and fuel oil, and in turn ramping up their exports of said products to Europe. So if you look at this chart, in February, the month that the product price cap came into effect, diesel imports were around 30,000 barrels per day, and it jumped to almost 200,000 by May. Exports to not exclusively to Europe, but exports doubled, and most of that increase was directed to Europe. Now, just as Urals has not too long ago, jumped over that cap, so have Russian products. They have surpassed their respective caps recently. Coinciding with this, we did see product exports from Russia to the Middle East plummet. It might be taken as an indication that the Saudi bargain hunting for cheap products is over now that they've surpassed the caps. However, it is a little too early to tell, given the timing. And for now, we are seeing product flows from Russia to other destinations like Singapore holding up fairly well. Given all these circumstances, what can we expect moving forward? Right now that we have a Urals discount that is continuing to shrink. At the beginning of the year, we're above $40 per barrel. We're around 14 now. Given that we've surpassed the caps, which means smaller fleet available for sellers and buyers, and we haven't heard from the G7 readjusting that cap yet. On top of that, we have the now more serious export cuts, and with the recent attack on a tanker in the Black Sea, we're got introduction to a, let's say, geopolitical risk factor. While all these factors may lead us to believe that supplies might be somewhat restricted, at least in the near future, compared to the first half, we have to caveat that, first of all, like we mentioned before, domestic demand in Russia is at a seasonal peak right now, and Indian refining will make a larger comeback in the fall. And at the same time, we have Saudis continuing to raise OSPs across all grades and all destinations every month, which could scare some Indian refiners back into Russian arms. And one more point about the Russian cuts. We've mentioned they seem more serious. However, as we said, they're only after 1 month already tapering that cut, only taking a portion of it through September, while the Saudis made it pretty clear that they're going to stand firm with the unilateral cuts. Now, ultimately, the fate of Russian oil will also depend not only, of course, on Indian appetite, but on Chinese appetite as well. And Troy will share with you some of our expectations around Chinese oil demand.
Thanks, Kareem. So yeah, China's policy pivot away from zero COVID ultimately failed to propel Chinese equity markets, the yuan, and oil and commodity prices just broadly higher in the first half of the year. That can be seen in oil, it can be seen in copper, and many other places. Now, amid this initial policy pivot, crude imports in China did surge, but this quickly translated into surging refined product exports, which depressed refining margins globally moving through the first quarter of this year. China did avoid inflation, unlike the West, but because of growing debt burdens, years of lost wages, high unemployment, and lack of fiscal stimulus and social safety nets, that meant that the emergence from lockdowns simply did not translate into surging oil and commodity prices as many in the industry had hoped. The Chinese party has had very little success reorientating the Chinese economy towards greater consumption-led growth over the past decade, and this creates significant difficulties for Chinese policymakers when they look for options to stimulate economic activity. Now, one major factor kind of moving into this year was around the increase in Chinese travel, both in domestic, automotive travel, but also in large part air travel. And while travel within China did surge in the spring holiday period, with domestic holiday travel during the May Day holiday reported about 20% above pre-COVID levels, this reflected the first major holiday that hadn't coincided with a significant COVID outbreak since restrictions began to be lifted in December. However, in the following weeks after this holiday travel surge, China was hit with another wave of COVID that disrupted economic activity from late May through June. Over the latest major Chinese holiday period, which was Dragon Boat Week festival, travel was down nearly 23% from 2019 levels. And if we look at Chinese international travel, it is increasing, and there have been some recent announcements in just this week that should continue to allow that to increase. But Chinese international flight capacity is still just around half of what it was at this time in 2019. So we have the domestic side, but we also have what's going on with international trade, which feeds back into their domestic economic activity. The Chinese economy is still extremely dependent on export markets, as exports made up about 20% of GDP in 2022, which is their highest share since 2015. Demand weakness for Chinese goods in the West continues to be a headwind for Chinese economic growth and oil demand globally, as demand for waterborne container freight and airborne freight have slowed despite the reopening in China. Maersk, which is the world's second largest shipping company and often seen as a bellwether for global trade, just recently in its Q2 earnings call warned of a much deeper pullback in global shipping container demand than they had expected. They now expect volumes to fall by as much as about 4% this year, when their previous worst case scenario was just around a 2 to 2.5% decline. And similar developments can be seen across the kind of logistics chain, whether that be from FedEx or demand for shipping inputs like cardboard, for example. Now, as we said earlier, Chinese imports did pick up pace, and Chinese crude imports, in fact, surged near record highs in June. But this should come as little surprise given that Chinese refiners have a long history of buying on price dips, regardless of what domestic demand looks like. Given the lag time in deliveries, the surge in June imports follows China going on a buying spree for Iranian, Venezuelan, and Russian oil back in the spring. And while Chinese customs data may not show surging Iranian imports, we know that this is merely being designated as Malaysian crude, given that Chinese crude imports of Malaysian oil have hit a pace this summer that is triple Malaysia's actual crude production capacity. However, even with all these, with imports picking up pace and nearing record highs, how much of that crude has been actually imported to be refined and consumed domestically versus being pushed into inventory or exported as product ultimately determines how bullish or bearish that rise in imports is. And in July, for example, headlines were filled with reports of China's record oil demand. But we've got to really caution against this kind of simplistic reading of Chinese data. Because China doesn't release oil inventory data, reporting agencies often calculate an implied demand figure using reported domestic production, imports, and exports. Now, this faulty approach assumes that inventories hold steady, which is never the case in reality, of course. And in fact, companies like Vortexa and Kepler, who track Chinese crude inventories, currently see crude exports near their record highs that were set back in 2020. And at the same time, Chinese refined product exports were up about 40% year on year, in the first half of the year as refinery runs pushed higher and domestic demand disappointed. Now, when we think about where Chinese demand is going from here, one major factor there is the growing petrochemical refining or petrochemical complex capacity throughout China. And that's continued to grow this year and expected to continue to grow into the second half. But China's rapidly growing petrochemical production is already leading to oversupply and weighing on petchem activity elsewhere, where petchem margins globally are now down about 40% versus 2019 levels and should continue to weaken throughout the rest of the year. With near record volumes of crude in storage in China and refining margins still plenty strong, we expect an increase in China's refined product export quotas to be announced sometime here in the next couple of months, and renewed strength in product exports should be expected to follow. Now, when you combine this with a host of kind of, bearish macroeconomic data points, whether that be the urban unemployment rate, their youth unemployment rates, which are at a record high of over 20%, or just the fact that, epidemiologists and virologists expect that there are going to be fairly severe COVID outbreaks there on about an every 6-month basis. When you combine all that with what we discussed with the Chinese government's kind of inability to easily stimulate consumption, you can see why China's not very likely to be the big bullish force that many had expected this year. We expect these macroeconomic and oil market developments in China to really help limit Russia and Saudi Arabia's efforts to push prices significantly higher as we move through the second half. And in fact, just this week, Chinese trade data released for July shows that exports plummeted almost 15% year on year and imports were down over 12%. So Chinese diesel exports, we must mention this, they did drop sharply in July. But as I said a moment ago, I really think that this is more reflective of the lack of export quotas than anything else. So a new batch of product export quotas moving into the fall would really help limit global draws to diesel inventories and weigh on prices. And an outlook for slowing Chinese crude imports in the second half and continued disappointment in their economic activity really looks set to continue to be a pain in OPEC's side going forward.
Yeah. And OPEC certainly has experienced their fair share of pain already over the last 6-7 months. In fact, like if you look at price developments, let's say through May or June, you'd be forgiven to forget that OPEC has actually been curtailing supply since November. We saw continued, restrained supplies like we did last year, albeit for slightly different reasons, namely, production discipline this time around. And just as with Novak, we had the Saudi counterpart, Abdulaziz bin Salman, also repeatedly announce more cuts, deeper cuts, unilateral cuts. And these announcements were also followed by rallies, right? But they were rather short-lived and overall didn't really move the needle that much. So, considering the first few months and the actions here, it would seem that OPEC intervention has lost some of its bite. And this forced the Saudis back into the position of swing producer, where they decided in July to shoulder an additional 1 million barrel per day cut, almost unilaterally, and there were a few members that participated. And this indeed did have a sizable effect, right, with the market as we see it currently, which also led them to extend the cuts through September, at least through September. Now, the effect on benchmark prices was sizable, but where we really saw the impact was on crude quality spreads, especially when it comes to prices of sour crudes. Because not only do we have voluntary or additional cuts from Russia and from the Saudis, we had a lot of outages earlier this year, like in Canada, where wildfires shut in substantial amount of heavy sour production. We have Kurdish oil that's still off the market, has been off the market since the end of March. That's another 400,000 barrels per day right there. And overall, we estimate that a little over 1 million barrels per day of planned non-OPEC supply outages have been seen in May and June, which severely tightened the sour crude market and led to a bunch of sour grades actually flipping to a premium to light sweet benchmarks. Dubai, for instance, is just recently hit a historic record premium to Brent, and has been at a premium to it since early July. It was, yeah. Now, given that development in sour crude prices, we also have to note the impact of that on refining margins. As you can see in the chart, the red line is 3-to-1 crack, simple 3-to-1 crack using WTI, and here we have a few Singapore cracking netbacks, and that divergence is partially because of that move, of that tightening of the sour market. And that also means that actual refining margins are really not as strong as simple light sweet base crack would have you believe. Although recently we did see margins pick up a little bit, strengthen a little bit, mostly because of some outages. Now, when it comes to where margins will head from here, aside from the obvious questions surrounding oil product demand, we also have to mention that refinery capacity is growing. We still have a lot of projects, planned to come online later this year. In China, we have the giant Dangote refinery in Nigeria, still expected to ramp up. So all this also carries the potential for crude demand actually outpacing product demand, which would squeeze margins. Now, one more point that I think is important to make on this whole OPEC cutting that's been going on since November. If you would move to the next slide, please. And that is, thank you, that is OPEC spare capacity. If you think back, just the oil news of last year, this was one of the main bullish narratives: the lack of OPEC spare capacity. We're one unplanned outage away from spiking prices. Now, because of those cuts, as you can see in this chart here, spare capacity has been recovering, and actually now well above pre-COVID levels at more than 4.5 million barrels per day. So in a way, ironically, these cuts that are meant to protect price have actually removed one of the bullish factors for price, and build a comfortable cushion that really diminishes supply side risks. Now, as if all of this wasn't bad enough for OPEC already, of course, you think why have inventories continue to build when the 23 member alliance is curtailing production? Well, that was mainly because of non-OPEC production growth, which was really strong so far this year, where we had Brazilian production reach a new record in June. We have Iranian production exports really recovering. We saw a little plus out of Venezuela. And all in all, both the IEA and the EIA expect non-OPEC production to grow by around 2 million barrels per day this year. OPEC in their report released today pegs it at around 1.68, I believe, slightly lower. But still high enough. And of course, the main culprit, as always, was the U.S. We saw U.S. petroleum liquids output reach a record high recently. We saw exports very elevated for months now. And so I think, Troy, you have a little bit more on the U.S. Production part, right?
Oh, yeah, have much more. So, following the oil price crash in the early days of COVID, U.S. producers began returning capital to shareholders instead of maximizing production or drilling as fast as possible, just going all out to maximize production, right? And that was a major storyline. And, there's always been, seems like everyone, particularly the OPEC members, are always excited about any prospect of the end of U.S. shale growth. But as has been the case really for the past decade, almost every one of those, death of shale stories have been greatly exaggerated. So despite this kind of focus on returning capital to shareholders, total U.S. liquids production, as Kareem just said, is at a new record high currently. And U.S. crude production is just 100 to 200,000 barrels per day below the November 2019 peak. Most importantly, the annual crude production in 2023 is going to average a new annual record high, well above the 2019 levels. In fact, about 500,000 barrels per day above 2019 levels, averaging around 12.8 million barrels per day. By their own admission, the EIA has been underestimating production this year when you compare their monthly data to their weekly data. In the first 5 months of the year in which data is available, they underestimated by around 400,000 barrels per day. And as summer has progressed, we have been writing really since the start of the year, but increasingly moving into summer, that they've been underestimating production more and more. Our analysis leads us to believe that current production is actually around 12.8 million barrels per day rather than the 12.2 million barrel per day pace that you've seen reported in EIA weeklies for most of this summer. And this would put U.S. crude production, as I said a moment ago, just a couple 100,000 barrels per day below that record high set in November of 2019. Now, another kind of narrative that gets pushed is, well, they've been drawing down their drilled but uncompleted wells, and that's what's boosted production, but that's going to really come back to bite later this year. Now, while we will admit, yes, it's certainly, drawing down DUCs certainly helped boost production quickly in the, without the commensurate rise in rig counts in the months following, the initial crash. We're just not there. We don't believe that DUCs, this kind of diminishment or depletion of DUCs is going to lead to some unforeseen, great decline in shale production. And in fact, while rig counts lag price by 4 to 6 months, which implies slower growth from U.S. shale basins as we move through the second half, U.S. total production, when you consider everything else going on, we have offshore production growing over 200,000 barrels per day in the second half of the year. So, this has to be, taken with these kind of narratives that are always, as I said, calling for the end of U.S. production growth or shale growth, always have to be taken with a massive grain of salt, because as is evident on the chart in the right, U.S. producers are just constantly becoming more efficient, and with new drilling techniques, in fact, new well productivity has been rising lately. Now, for the rest of the presentation, I'm going to kind of be bouncing back and forth between the interplay between economic activity and oil demand. So U.S. oil production isn't the only thing that's been surprisingly strong this year. U.S. GDP and employment has held up much better than we had hoped, or we had expected, or that most economists had expected this year, and much better than the Federal Reserve likely hoped, given their efforts to try to get inflation back below their 2% target. Now, despite the rate hikes, given the expansionary fiscal policy over the past year starting to work its way into real economic activity like factory and infrastructure construction, and given that the U.S. has an extremely high level of fixed rate debt compared to both U.S. history and the rest of the world, and on top of that, given the willingness of individuals in the U.S. to go ahead and spend down their savings and accrue more debt, we have, in fact, yes, so far avoided recession. The recent factory building boom that I mentioned a moment ago, inspired by government incentives in the Infrastructure Investments and Jobs Act, as well as the CHIPS and Science Act, has led factory construction this year to boom, and it's actually making its largest contribution to U.S. GDP growth since 1981. That said, however, gasoline demand has continued to disappoint this year in the U.S., despite the relatively resilient economy. U.S. gasoline demand was up slightly year on year in the first half of the year, but remained about 4% below pre-COVID levels. And we think that a number of these factors are just kind of here to stay, like the rise in working from home, for example, post-COVID. It has proven sticky, and while, yes, there are a number of employers you might see reported in the news on a near weekly basis, saying they're trying to get workers back in the office, it's pretty clear that this is going to be an indefinite headwind for gasoline demand going forward, as there will be less people commuting. When you look at other sectors of the U.S. economy, while GDP has proven resilient and there's been this pronounced strength in manufacturing facility construction, as I mentioned a moment ago, the same just simply cannot be said for all sectors of the economy. Importantly, the most oil-intensive sectors of the economy have been experiencing their own recession for nearly a year now. The U.S. and OECD broadly is seeing manufacturing and industrial activity contract, weighing on diesel demand, naphtha demand, and natural gas demand as well, particularly natural gas demand and diesel demand in Europe, as natural gas is still, 3 to 4 times what it was pre-COVID levels. We can see this clearly in the U.S. distillate fuel oil demand data from the EIA. So far this year, in the first half, distillate fuel oil demand averaged about 2% below 2022 levels and a whopping 6% below 2019 levels. But we do see a little bit of light at the end of the tunnel, with U.S. industrial price pressures starting to ease and domestic manufactured good inventories nearing levels that are going to require restocking. We think that this should help and likely signals a recovery in distillate fuel oil demand and help support prices broadly, oil prices that is, moving into the fourth quarter. Now, when you combine what we expect to be a modest recovery in U.S. industrial and manufacturing activity in the second half with the routine seasonal influences of heating oil purchases and harvest season related diesel demand, you can see why U.S. distillate stocks are likely to continue to decline and U.S. exports are likely to slow. Now, despite this weakness in distillate and gasoline demand in the U.S. refined product stocks have continued to hold well below their historic norms and have moved lower as we worked through July and into August. So, in light of everything that I just described from an economic perspective, what explains this? Well, at the end of the day, unplanned outages, and I know I kind of started the talk with this today, looking at what happened last winter, but unplanned outages from winter, which shut in over 1 million barrels per day of Gulf Coast refining capacity, lingered all the way in through the spring. And these outages hit the Gulf Coast the hardest, but they also hit refiners in the Midwest and the Rockies. Then, as we worked into the spring maintenance was both deeper and more lengthy from a recent historical perspective for the refining sector. And with apparent delays and outages lingering much longer than planned at places like Marathon's Galveston Bay refinery or Valero's Corpus Christi refinery, we just did not see the rebound in refining activity moving into the summer as most anyone in the industry expected. And then on top of that, just as refiners were starting to run hard, going as summer began, leading into the July 4th holiday, for example, extreme summer heat led to a new round of unplanned outages across Texas, causing Gulf Coast refiners, to run about 400,000 barrels per day below year-ago levels during that period, which is really important considering that refining capacity in the region was up about 250,000 barrels per day year on year. And ultimately, without these outages, U.S. and global product inventories would look much different today, than they do. So when we look at another major factor that has contributed to limiting U.S. inventories of product despite the weakness in domestic demand, exports have been really key to that. On the one hand, these disruptions to refining activity allowed for stronger U.S. crude exports than would have otherwise been expected. But on the other hand, despite these refinery disruptions, U.S. net exports of refined products have averaged their highest in history so far this year. So averaging about 4.1 million barrels per day so far this year, U.S. crude exports are nearly 900,000 barrels per day higher year on year, and they're over 1.2 million barrels per day above the same average period from 2019. Current crude export capacity has grown this summer with the dredging at the Ingleside terminal in Corpus Christi, which boosts U.S. total kind of daily export capacity to around 4.5 million barrels per day. And we've seen that, that kind of threshold tested in recent flows data. Despite lots of debate over the past year, because there has certainly been, this has not been without debate, what's going on with domestic U.S. refined fuel demand, that is. Now, despite all that debate, whether or not domestic fuel demand is as weak as the EIA has reported, when you take a look at stocks and you take a look at net exports, for example, it's pretty clear that, without some domestic demand weakness, we would not be able to see such a record pace of net petroleum product exports. And so far in 2023, net exports of products have averaged 4.1 million barrels per day, which is up nearly 600,000 barrels per day year on year, and up a whopping 1.2 million barrels per day from 2019 levels. Now, considering what I just said and how important the export market has been to U.S. refiners, and U.S. refiners needing to clear more and more product via the export market amid depressed domestic demand, regional dynamics are increasingly important. So in this instance, on the chart to the right, you can see what lock maintenance on the Illinois River has meant this summer for refiners in the Chicago area compared to the Gulf Coast. Chicago area refiners typically barge diesel to the East Coast, to the Gulf Coast, and the Rockies. But because of maintenance on the river limiting barge traffic this summer, and because of domestic demand weakness, diesel stocks and to a slightly lesser degree gasoline stocks have swelled in PADD 2 relative to the rest of the country. Now, maintenance there on the locks on the river is set to last from the beginning of June through the end of September. So in October, we expect that rising volumes of product leaving the Midwest, in addition to the harvest season demand, related demand, it should support Chicago area refiners and margins in the region once again. Now, everything I just said, and I kind of we thought about leaving this off altogether, because in recent weeks, most economists have written off a recession this year. And we certainly believe that this kind of writing off of the recession risk in the US in particular has been a contributing factor to the oil price rally that we've seen in recent weeks, although the OPEC cuts that Kareem described earlier really, take precedence. But while I won't really dwell on this topic all that long, macroeconomics is kind of one of my favorite topics to discuss, so I felt compelled to mention this. So we're not building a recession into our price outlook here that we're going to describe at kind of our concluding slide, but it's worth noting that many leading indicators still suggest that a U.S. recession is likely in the next 6 to 9 months, and it's also worth noting that there have been instances in the past where many economists felt as though we were going to enter a soft landing, and it didn't happen. The landing was much harder than expected. And so at the very least, what we want to leave you with on this topic of recession risk is that while we can't say, and we don't believe anybody can really accurately time such an event, we can say with confidence that growth will not be what it once was amid this higher rate environment that we expect to persist into 2024. Now, when you zoom out and think about global economic activity and its relation to oil demand, the IEA actually just trimmed their 2023 demand growth expectations in July. And this is the first time that they've revised down their expectations for demand this year. Now, you might find that interesting, given that during the same period, the IMF actually revised their global GDP growth forecast slightly higher. What we believe is the important takeaway here is that the EIA is likely to continue to trim their demand outlook. In fact, I think their August report will trim demand further. And much like the chart you see on the right with global real GDP growth, while oil demand has surpassed pre-COVID levels, it's not increasing at a fast enough pace to catch up with the expected pre-COVID trend. And this creates all kinds of problems, in particular for the IEA and others who use historic data to project future demand. This is also particularly problematic if economic growth is not only below the historic trend, but also becoming increasingly less energy intensive over time. So much of the IEA's demand growth expectations for the second half of 2023 are currently based on an expectation of OECD demand rebounding rather strongly. And while we do believe, as we said earlier, that we'll see some recovery in U.S. manufacturing and freight activity moving towards Q4, we do not believe that it will live up to the IEA's expectations. Now, one major, kind of weight on global growth is Europe. The EU did enter recession moving into this year, and in a way, well, not in a way, directly that influenced natural gas demand. It influenced their ability to refill natural gas inventories. But of course, also the weather was a major factor here. So I'm going to kind of conclude here with a couple of weather discussions, which is that, the extreme warmth that we discussed in the opening slide that helped European natural gas prices really decline moving throughout the winter, that heat persisted through this summer. And we've seen record temperatures across many areas of Europe this summer. Now, the same could be said, for example, in Texas. However, in Texas, what this has led to is a spike in natural gas demand, record high electricity prices. However, unlike the US, where about 90% of homes have air conditioning, only around 10% of European homes are air conditioned. So with such a small percent of homes with air conditioning, this means that unlike in the US, where electricity and natural gas demand surge during the kind of the peak of summer heat, as they do in the peak of winter cold, hot European summers just don't result in that kind of impact on natural gas and electricity demand. And for the time being, European natural gas storage, as you can see on the right, is actually at seasonal record highs, which reflects both the weakness in industrial activity in the region, as well as this lack of impact from summer heat. Ultimately, this also feeds back into oil prices because this means that gas to oil switching risks will continue to be limited, and EU distillate demand will likely to be continuing to disappoint. So one last comment on weather impacts, because the most pressing weather risk for oil markets comes by the way of the Atlantic hurricane season, which runs from June 1st through the end of November. A couple major points to make here is that water temps across the Atlantic basin are at record highs, and that does increase the odds of some rapid storm intensification. However, if current forecasts hold and an El Nino inspired return of elevated wind shear moving into September picks up pace, that should really limit hurricane risk to the Gulf Coast oil and gas infrastructure during the majority of what's considered peak hurricane season from late August through October. However, we have to leave this caveat, of course, that given that remarkably warm water temperature that I described a moment ago, the risk of even a single extremely strong storm making landfall should not be overlooked, particularly given the refined product inventory levels that we discussed earlier. So this slide is just kind of a summation of the risks that we just described at greater length. Ultimately, we expect that the balance of these factors will continue to lean toward the bullish side as we expect prices to continue higher in the near term as momentum builds and global crude stocks draw. But we also have a slew of bearish factors that look set to limit the upside in prices. So when we just give a broader forward look for the remainder of the second half of the year, we expect benchmark prices to be largely range bound with a bullish bias through September that we believe will push WTI to test the $90 level and Brent to trade in the low to mid 90s. However, as we all likely know on this call, once sentiment in a commodity market and particularly oil markets start to shift and momentum starts to build, it's typical to see prices overshoot what underlying fundamentals would imply. So we're not ruling out a short-lived excursion to test some technical resistance levels at the low, $100 to $104 level, particularly if we get a hurricane that shuts in significant levels of offshore production in the US. But all that said, if we can just leave you with one overarching point of this entire presentation, it's that a managed market supply deficit just simply is not the same as an organic supply deficit. Given that the tightness in the market today has been created by significantly increasing spare production capacity, as Kareem described earlier, this will limit bullish tail risks as we move towards 2024, which I must remind everyone is expected to be another year of slow economic growth and record non-OPEC production. And if you would like any more information or want to follow up with us on any of these things, feel free to reference these links or email us directly. I'll hand it over to you, Shannon.
Perfect. Thank you. Thanks, Troy and Kareem. That was a lot of information to cover. And as Troy mentioned, if you have questions for Troy and Kareem, you can reach out to them directly, or you can find their blogs and information about ProfitX on our website. Additionally, we have a hurricane outlook webinar coming up in the next few weeks that Troy will be presenting on. And if you'd like more information on that or would like to register, you can find information on our website. So if you have any questions, please put them in the chat window. We do have a few here, fellas. First one. Do you think another emergency SPR release is likely as prices rise?
So I'll take that one, Kareem. Feel free to jump in as well if you'd like, but I do not think so. I think that for example, earlier this year we had SPR releases, but those were congressionally mandated from the budget. That was not considered like an emergency SPR release as we saw last year. And while we expect prices to rise, as we discussed in this webinar, in the second half, and to test some levels that will certainly make the Federal Reserve sweat, and policymakers and politicians that are hoping to keep inflation down. It's going to raise some concerns with them, no doubt. But we don't believe that prices are going to get high enough to compel another emergency SPR release. And in fact, right now the Biden administration is slowly building back SPR volumes. Like I said, I'm not going to give it too much credit. It's a very small amount, and they've even pushed off further resupplying of the SPR, given what prices have done. All that said, right, that's just really me talking the second half of this year. If something dramatic were to happen, like some massive escalation in Russia's invasion of Ukraine or something like that, that were to take a considerable amount of crude off the market as we move into 2024, which is an election year, we should not rule it out in 2024. But that's that's still off a ways. We'll have another webinar in December or early January discussing those types of risks. But for now, the second half of this year, we don't see that happening.
Okay, thank you. And it looks like we have one more. What do you think the recent Ukrainian attack on a Russian oil tanker means going forward?
Take this try. Yeah, sure. Yeah. I've mixed feelings about it, right? Because on the one hand, it is it is setting a new precedent. And we saw that Ukraine announced in reaction to Russia pulling out of the grain deal, they announced that the Russian seaports along the Black Sea, and they named 6 cities by name, are now not off limits anymore. They're now considered active war zones. However, as we said, that tanker that was targeted specifically was one on the U.S. sanctions list. That it was smuggling fuel to Syria. And if news reports are to be believed, the sea drone attack, it was purposefully geared towards hitting the engine room, which would cause the tanker to stop, but would avoid a environmental disaster and obviously a PR disaster for Ukraine too here. So we don't see a full out new geopolitical risk here, but certainly that's something to pay attention to moving forward.
Yeah, and I'll add that one thing that it likely will do, right, is ramp up insurance rate and freight rates out of the Black Sea there, because it's gonna insurance companies are gonna take note of that at the very least. Whether or not it really materially affects flows, I think that's unlikely unless it severely escalates. But there will be some impact on the ability or on the pricing around freight and insurance.
Which of course impacts also non-Russian oil, right? Lower than the Black Sea,
that's right. Yeah,
as I call it. Yeah.
Right. Well, thank you everybody for your time and for joining today, and a special thanks to Troy and Kareem. We will be sending out an email in the next day or so with a link to the rebroadcast of this webinar. We hope everybody has a good day, and thanks for joining us.
Thanks, everyone.